The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.
Well, as a look across the grain and oilseed trade and the stock market too on Tuesday, kind of ended up with a risk-off type of trading day. Some moderate losses in corn and soybeans, a little more pressure in Chicago and Kansas City wheat on the session. And we did see cattle move their way a little bit higher after kind of trading mixed to lower on the day. So it wasn't all bad, but just kind of a blah day on Tuesday. Let's try and make sense of it, though, and talk about things. Joining us for market analysis, Tyler Schau with agmarket.net is with us. Tyler, it's good to catch up with you again. I know we got a chance to talk a little bit last week in Houston, Texas during Commodity Classic, and good to see you're back home and somewhat recovered from last week's festivities, Tyler.
Yeah, it's taken a few days, but feeling like we're settled back into the office here. So,
well, and that's always a good thing, and I'm with you on that sentiment. Settling back in, though, yeah, we had a okay day Monday, but then kind of just blah on Tuesday. Largely felt risk off. Some of that pressure, maybe the stock market weighed in on things a little bit, I have to think. I don't know. It just felt like generally the path of least resistance in the grains Tuesday was just to move a little bit lower.
yeah, it was the turnaround Tuesday people don't like to talk about when we have a decent day on Monday and then have a sell-off on Tuesday. You know, if I was to point to anything in particular, you mentioned wheat having a really tough day. Russia just keeps coming in and lowering their export price and really making everyone else uncompetitive in the world market. You know, and I know a U.S. producer is going to say, well, we're already low priced compared to where we were the last 2 or 3 years, but we're still the highest priced game in town. You've got Russian wheat considerably cheaper. Last I saw, they were below $215 a metric ton offered FOB in the U.S. When we talk hard red, Kansas City wheat, we're closer to 250, 260, and Minneapolis is 270. So considerable price difference there. And Matif wheat, that would be the European or the French wheat's also much cheaper. So it's really tough to stay competitive. I would look for the USDA on the WASDE report on Friday to lower their exports again on U.S. exports on wheat, which is just kind of weighing heavy on this market. That might have been a contributing factor to the performance on corn and beans today, but also, you know, it's almost like clockwork. We get those contracts up to that 20-day moving average. We finally feel like, you know, we get above the 10-day, kind of feel like we got some momentum going on, and I think these funds just come in and plow into that on the short side pretty hard and just take any momentum away from us.
Well, on the wheat side of this equation, let's stick there for a minute. And I know you and I kind of talked sidebar last week about, you know, what you were hearing with folks at Commodity Classic and things like that. And thinking about U.S. wheat still being the highest priced game in town here and all that cheap Russian wheat, et cetera. Thinking about spring wheat acreage here coming up as we get ready to plant. I mean, do we think that just where the price levels are, that could maybe move some folks away from planting spring wheat? You're up there in North Dakota. You're in spring wheat country. I mean, what are you hearing in that regard, Tyler? What do you think?
That is one of the things that we've been talking about some and that we're hearing is, you know, the other thing to mention too is you've got a crush plant, soybean crush plant that recently went online in Spiritwood, North Dakota, Green Bison. They've had some struggles getting up and running efficiently, but they've pretty well got all the kinks worked out and are probably going to be going full bore. Got another one going online this summer in Castleton, North Dakota, which just saw some news today that they will be starting to crush beans this summer with the goal of having all the kinks worked out by harvest of 2024. So I mean, I say all that to say those plants are going to gobble up a lot of soybeans in the state of North Dakota. It's going to be good for the soybean producer, good for basis levels. But the other thing I would expect to see is maybe some of those acres in the eastern half of the state that typically would go into spring wheat might see there's talk we're going to see quite a few of those acres move into soybeans. One, they're going to need a lot of beans to fill those plants. Right now, prior to these crush plants coming online, it was something to the effect of like 90% of the soybeans grown in North Dakota got on a train and went to the Pacific Northwest. So that market's still there. P&W is still going to be trying to buy some beans. We're just going to have to grow more here in North Dakota. And the idea right now is a lot of those acres are likely going to come from spring wheat with where prices have gone. Soybean prices, they've fallen, but not near the extent percentage wise as you've seen wheat fall. And then the other thing to throw out there is, cost of production has risen more as a percentage of the overall crop in the wheat market than it has in the soybean market. So costs are up across the board, but when you look at cost per bushel, it's really gotten expensive to grow a crop of wheat here in the last few years.
No, I'm glad you brought that up. That's kind of where my mind was tracking, was that cost of production on the wheat side. And you think about some of those, fringe areas, as they've been called in the past. I don't know if I want to keep using that term, but I haven't found a better one. But just seeing, some of those areas, to your point, maybe going more to soybeans in the northern plains. And I think too, just throwing this out there. I mean, have you seen the price of cotton lately? I mean,
Yeah.
cotton in the South, it could be another driver here to maybe drive some of these acreage shifts here this year, Tyler.
Yeah, that's actually one of the things we talked a little bit about yesterday in one of our meetings is, just that price of cotton and what it's done. Might see that pull some acres in the south, away from corn, which would be beneficial. Might see it pull some away from soybeans as well. It'll be interesting to see how the next couple months shake out as we get into this quote unquote acreage battle. The difference this year, a lot of people are looking for that acreage battle to really push prices higher. One of the things I caution on that is the difference this year feels like it's more of a acreage battle to push acres away, not to draw acres in. So it's a little bit different of a setup than we've seen in previous years.
Well, you mentioned this earlier, kind of getting up against those 20-day moving averages, particularly in that corn market. And really looking at things here, it feels to me like this grain market might be marking time and chopping sideways until we get to that WASDE report coming up on Friday. It feels like we just don't have enough of that strength. We rallied off a low, maybe short term, but we don't have enough strength to really move this market through some of that overhead resistance right now, Tyler.
Yeah, we need to see something that, I don't know how much stock I'm going to put into this. The Bloomberg survey on the WASDE report, they've got the average of the analyst expecting to see the carry out or ending stocks on corn down about 17 million bushels. I believe in February it was like 2172, and the average of the estimates is 2155. Bear in mind, they're not going to change anything on the supply side. The acres are set, the yield's set. They won't touch the yield on that until like next fall. So the only thing they can really adjust is demand, and the idea is ethanol's been running strong. It appears like ethanol will continue to run strong. Don't be surprised if we don't see some revisions upwards on the ethanol. I don't expect them to change exports one way or the other. So in my opinion, that's where that lower ending stocks is coming from. It's not a huge, it's not a game changer. It's less than 25 million bushels. I don't see that as being the bullish catalyst. The one I think might be more important and people are probably looking forward to more is March 28th when we get the planting intentions report and the quarterly stocks report.
We are talking today with Tyler Schau from agmarket.net. And, you bring up that end of the month quarterly stocks and acreage number. And I too believe that's going to be probably our next big catalyst in the road. The WASDE, of course, will be maybe a day newsmaker unless we see something unforeseen. But that feels like the next big thing in front of us. And, you throw in South American weather has been pretty favorable here. So, I'm fishing for news stories, so to speak, in this market, Tyler, but we're just not. They're fundamentally, I mean, you look at the charts, corn, beans, wheat, fundamentally, there isn't really much of a reason to change the sentiment in these markets. And a lot of those funds and managed money just continue to be at or near record short, while the farmer remains pretty long in a lot of these markets, Tyler.
Yeah, we need something. You mentioned South American We had Eric Snodgrass on with us yesterday and doing a webinar, and one of the things that he was talking about was the next 2 months, probably the trade is really going to be paying a lot of attention to the weather in South America as well as the weather in North America. So like weather becomes really important in North America in that June, July timeframe, right? July, especially on corn, July pollination timeframe. June, we need to get a decent amount of rains, and we need growing degree days and all that kind of stuff. It's bumped up a little bit in South America because they're putting that safrinha crop in the ground now. It's a shorter day variety, and so one of the things that my takeaway from Eric's talk was this March, April, May timeframe is going to be really important because it's kind of catching both big weather windows for both hemispheres. And with Brazil, especially, or South America as a whole, kind of taken over as the leading exporter of corn over the U.S. Now all of a sudden it's kind of like that shift we saw 10 years ago with soybeans, where Brazil or South America took over as the leading export of soybeans. And all of a sudden we had to pay a lot more attention to their weather and where they were at in their growing season. We're starting to see that more in the corn market. So I think you'll see an opportunity for those funds where they're going to feel like they need to exit their short positions because there is some threatening weather in maybe both hemispheres, one or the other. I just, it's hard to believe that we'll make it through, the next 3 or 4 months without some type of catalyst or scare that gets them to decide they want out. And typically they don't hold a short position through the North American planting season. They might plow into it once they feel the crop is made, but I expect there to be some changes. But to temper any bullishness there, my caveat there is don't forget the farmer's still long a lot of bushels in the bin, and far more bushels than the funds are short. So if they do jump out and we do get a rally, that's probably going to be tempered by hedge pressure and farmer selling.
And I was going to say, with that in mind, I mean, thinking back to last week at Commodity Classic too, what did you hear from folks? We've heard a lot of the same that you just mentioned. A lot of farmers are long in the bin still, especially on corn. They gotta make some sales. They're not happy with the price. They don't know what to do. I mean, what did you hear last week at Houston? Was it kind of that same sentiment? A lot of farmers asking questions. Should they try and get some floors locked in here, manage their risk as much as they can? I mean, realistically, what should we be thinking about in this window here, Tyler?
Well, the first thing, that was one of the common themes I heard. And I wanted to have a little fun with it, and I wanted to go try to find a bell and put a sign up that says "Ring the bell if you got corn to sell." But I was voted down because they thought we might annoy all the boos around us. So we didn't do that. But we had a lot of producers swinging by, asking a lot of questions on, I didn't sell enough. What do I do now? I tried to tell them all, number one, misery loves company. You're not the only one. A lot of people got a little lackadaisical in marketing. For the last 3 years, the right move was to do nothing and wait, and prices tended to get better. And that has not been the case really for the last 7-8 months now. We've kind of been out of that boat, but people are still hesitant to make sales. So the answer I've got, and it really can go for all three crops, is I hate dumping the stuff here. Most of the country basis is fairly good. Futures have fallen off quite a bit, so basis has strengthened. One of my fears is if we do get that rally, if we do get a catalyst that gets this thing pumping and gives us an opportunity, futures might rally, but I fear cash prices will just kind of stay flat. Basis will widen out as those bushels start to roll in, and the end user and the merchandiser don't have to work quite as hard to get their hands on those bushels. So one of the strategies we've been pitching is go ahead, make some sales, take advantage of good basis. Option volatility, especially in corn, even in wheat and in beans, has really fallen off from where it was a year ago. Premiums are fairly reasonable, and in most cases, what you would pay in storage and interest costs, you can own a call option for the same amount of money or less. You can remove your downside risk. So if this thing continues to bleed, you don't have to worry about that. And we've got a mechanism that owns this market if it does rally. And if you're undersold on new crop, we're even looking at some strategies where we start selling some calls on new crop corn and beans to help pay for it. And then, best case scenario, we end up in a bind where those, we're mad we sold those calls, but that just means the market's rallied and given us an opportunity.
Good thoughts. Good thoughts for sure. Let's talk livestock. Cattle looked like a bit of a consolidation day Monday, and then we kind of rallied late on Tuesday's session. I guess I'll start it with this, Tyler. Do you have your bullhorns on in this cattle market like many folks do, or where are you sitting at right now?
I've been pushing the producers I work with to manage some risk here. That's whether it's put options, LRP, selling the board and buying calls, whatever. I think you do want some flexibility. A lack of flexibility really hurt a guy last year, because we did make that big run. I'm less bullish here, and the only reason I say that is it's just really hard for me to pencil out how I can go and buy a $270 800-pound steer, stick them in a feedlot and feed them for 6 months, and turn around and sell them for $192 fat. And the most simple form is I've got to have a cost of gain below about $1 a pound. And I know corn is considerably cheaper today than it was a year ago, but that's an all-in cost of gain. That's labor, yardage, capital expenses, everything to boot. And it's just hard to pencil that out right now. So if we do continue to see a major rally, we're going to have to see fat cattle really lead the charge. It can't be feeders. Felt like feeders have kind of led it here for the last, really the last year, to be right honest with you. They've done most of the lion's share. Fats have kind of followed along. So that's got me a little bit concerned. And then, you kind of let off with the financial markets and the stock market. And I know, the stock market's done nothing but go up over the last several months. But, it's one of the fears. What happens if this thing tips and we start to get worried about the overall macroeconomy? Are consumers still going to be willing to go out and spend? The one thing I can say is I got to eat at a couple nice steakhouses this last week. Doesn't appear like consumers are done buying yet, because they were out in full force, and the bills were not cheap. But it is a concern. I just wonder how long it can stay that elevated and we can stay competitive.
No, that's a great point. And you think about that. If beef starts to get too high for folks, well, maybe pork or chicken slides in there. But in the
Yep.
case of this hog market, even lately, it's $100 summer month hogs. So I mean, pork's getting back up there a little bit in
Yep.
price as well, Tyler.
Yeah, pork is going to stay elevated. It's one of those things. I think you'll see people make those switches. I don't want to be the doom and gloom guy. I realize there's a lot of fundamental support under this market with the supply side, but you still got to be able to sell it. And at the end of the day, the last thing I will point out on cattle, like with the feeder calf market, whether it's buying puts or LRP, you can lock in a worst case scenario that's anywhere from $3 to $5 above the highest cash price you've ever seen. So, it just makes good sense for me to lay into some risk management here. On the fat side, it's a little bit different. Like I said, it's tough to go pay the kind of money they've had to pay to lay into some of these cattle to get them on feed. But you can still kind of maneuver around and get close to a break even on them, protected as a worst case scenario. And I know no one likes break even, but it's better than losing a couple $100 a head.
Tyler, any final thoughts for us? Anything you want to reiterate to folks here on the show today?
Just I pay attention, have orders working. That's kind of the big takeaway. I've been talking to guys. Pick spots, whether it's on grain or livestock, where hey, I'm going to lay into some hedges. I'm going to buy some puts. I'm going to buy the LRP, whatever it is. Start doing that math now. Have the order working. Whether that's at your cash grain buyer, whether it's with your commodity broker, and be ready to execute. Because one of my fears is that we're going to get that rally. It's not going to last very long, and people are going to assume it's they're I don't want to say greedy, but they're going to get their goggles on and set targets up above the market, which is a good thing to do, but might be time to take action. Because if we do have a good growing season, now you're looking at nearing a 3 billion bushel carryout for the next crop year, and and that don't scream $5 corn.
Nope, it definitely does not. Great conversation. I know folks can reach out to you and your team with questions. Agmarket.net's a great place to start. Tyler Schau, agmarket.net. Always good to chat with you, my friend. Thanks for joining us on Market Talk today.
You bet. Thanks, Jesse.
All right, that's going to do it for the show. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.